Hello, everybody, and welcome back to the Finance Zone. One of the most chaotic years in decades is finally winding down. But investors aren't out of the woods yet, and there's still an incredible amount of uncertainty packed into the final 2 months of 2020. In November, Wall Street's obsessive focus on the prospects for another stimulus package will remain front and center. But the digestion of third-quarter earnings, the result of the U.S. elections, and the continued global course of the pandemic each loom as obvious catalysts that investors will need to rapidly factor in. Today, we're going to be talking about top 10 stocks to buy November 2020. Make sure you stay until number 1 as you don't want to miss any of the information stacked up for you. Number 1. ViacomCBS. VIAC. Media and entertainment giant ViacomCBS might not be the sexiest stock on the list. Its shares are down 31% in 2020, but it's a long-term value play with staying power, making it an attractive stock to buy for November and beyond. Income investors will find something to like in VIAC's 3.3 dividend yield and its conservative 21% payout ratio. The media conglomerate owns CBS, Comedy Central, Showtime, MTV, BET, and Nickelodeon, among other valuable global brands. When the pandemic first hit, investors worried the sudden termination of live sports would decimate ViacomCBS. But those fears quickly proved to be overdone, and Viacom has already secured rights to carry some NFL playoff games in January. Barclays recently upgraded the stock from equal weight to overweight, boosting the price target for VIAC stock from $22 to $36. The NFL negotiations, a more stable cash flow environment, and improving streaming revenue were cited as catalysts. The company reports earnings on November 6th. Number 2. NextEra Energy, NEE. Electric utility NextEra Energy purports to be the world's largest producer of wind and solar energy, and it's unquestionably one of the leading renewable energy companies in the U.S. Utility stocks are often safe havens in times of turmoil, which is part of what makes NEE an attractive stock to buy for potential tumultuous November. Some investors might find a certain speculative appeal to NEE as well. Should former Vice President Joe Biden be elected, NextEra Energy could be in a position to receive tax credits, subsidies, and other favorable incentives aimed to encourage its investments in renewable energy. Although NEE promises to offer steady growth going forward and pays a 1.9% dividend, investors have been bidding the stock up this year. It currently trades for 38 times earnings. It's up about 25% in 2020 and underwent a 4-for-1 stock split effective October 27. Number 3. Facebook, FB. Named one of the U.S. News best stocks to buy for 2020, Facebook may not be among the favorite picks of environmental, social, and governance investors, but its potential as a long-term holding for investors is impossible to ignore. Along with Alphabet's GOOG, GOOGL, Google, Facebook and its family of apps dominate the digital advertising market. With Google now at the center of the largest big tech antitrust lawsuit since Microsoft, MSFT, 2 decades ago, Facebook could find itself with more strength in an already oligopolistic market. Although it trades for 36 times earnings and is worth around $800 billion, that valuation is by no means unreasonable for a company in Facebook's position with no long-term debt, more than 3.1 billion monthly active people using its services, and earnings growth over the next 5 years expected to be around 20% annually. Number 4. Berkshire Hathaway. Markets are cyclical. What's in favor today won't be in vogue forever, and what's out of favor today will once again return to prominence. Berkshire CEO Warren Buffett is the world's most famous and most successful living value investor, a strategy currently suffering its worst run relative to growth stocks in about 200 years, according to recent reporting from the Financial Times. Shares of Berkshire Hathaway, which is heavy on insurance companies, banks, and old economy businesses like railways and utilities, are down about 8% year-to-date as tech stocks have dominated Wall Street. That's perfectly fine for the patient and conservative long-term investors, who should view Berkshire Hathaway shares as a way to insulate their portfolio for extreme volatility and put some money with the greatest investor of all time. At the end of last quarter, Berkshire had more than $146 billion in cash on hand available to make opportunistic deals with. Number 5. PayPal Holdings, PYPL. Last among the best stocks to buy for November is digital payments giant PayPal, which stands in sharp contrast to value stocks like Berkshire. PYPL is an all-out growth stock, with shares up more than 85% in 2020 as the sudden dramatic shift to e-commerce and mobile transactions have accelerated the pivot to a more cashless society. PayPal, which owns the popular mobile payment platform Venmo, recently announced it would be allowing customers to trade cryptocurrencies, and not merely trade them, but make purchases with cryptocurrency through its app. That move only boosts the opportunity for user growth, which is already impressive. Last quarter, PayPal set a record for a net new account 21.3 million and posted an 86% increase in quarterly profit. Number 6. Fastly. Following a 50% pullback in a matter of weeks, it's officially time to pound the table and beat the dead horse on edge cloud computing services provider Fastly, NYSE, FSLY. As you might recall, Fastly lowered its third quarter revenue guidance a few weeks ago to range of $70 million to $71 million from a previous forecast of $73.5 million to $75.5 million. With TikTok responsible for 12% of the company's sales through the first 6 months of 2020, and TikTok involved in a dispute with the Trump administration stateside, ByteDance, the parent company of TikTok, significantly pared back its resilience on Fastly for content delivery and security. While losing a big customer is never ideal, a closer inspection of Fastly's third quarter operating results, released last week, shows Wall Street's concerns to be largely overblown. Even with TikTok usage declining, revenue still grew by 42% year over year, with Fastly picking up 96 new customers, including 9 new enterprise clients from the sequential second quarter. Number 7. CVS Health. Don't worry, value stock seekers, I haven't forgotten about you. If deep discounts are more your thing, pharmacy chain CVS Health, NYSE CVS, has the tools and intangibles to make you richer in November and beyond. CVS Health has lost more than half of its value since mid-2015, and the combination of increased online competition, weaker generic drug pricing, and slower foot traffic tied to the coronavirus disease 2019, COVID-19, pandemic have all extracted a toll. Yet, at roughly 8 times next year's profit forecast from Wall Street, CVS is as cheap as it's been in a very long time. Though CVS Health is a brand name stock, it does have a number of catalysts that can reignite its growth engine and make its shareholders, myself included, richer. For one, CVS plans to open approximately 1,500 Health Hub health clinics around the country by 2021, or perhaps a tad later now that COVID-19 has disrupted things from an operational perspective. These health hubs will specifically focus on patients with chronic illnesses and aim to get these folks in touch with physicians or specialists. It's a means of engaging with CVS local community and driving repeat traffic through its doors or online portal. Number 8. Freshpet. A stock that can make you richer in November and beyond is natural and organic pet food and treats company Freshpet. NASDAQ FRPT. Whereas Fastly and CVS Health have fallen significantly from their respective all-time highs, Freshpet is within a stone's throw, or should we say squeaky ball's throw, of its record closing high. Despite being a pricey stock, this is a company that's shown it deserves every bit of its premium received. First off, consider the companion pet ownership and spending metrics behind a company like Freshpet. Data from the American Pet Products Association shows that year over year, U.S. companion pet expenditures haven't declined in at least a quarter of a century. In 2020, it's estimated that $99 billion will be spent on companion animals, with $38.4 billion of this derived from food and treats. With an estimated 84.9 million U.S. households owning a pet and nearly all of these owners viewing their companion animal as part of the family, it's no surprise that they'll spend big bucks to ensure their well-being. Secondly, investors need to understand that Freshpet is to the pet industry what natural and organic food producers were in grocery stores in the mid-2000s. Pet owners are more than willing to pay higher prices if they're getting a product that's perceived to be more nutritious for their dog. These higher prices should translate into higher margins for Freshpet over the long run. And finally, keep in mind that Freshpet is still in the early stages of its marketing and brand awareness campaign. Even though it has a presence in over 22,000 retail doors, and climbing, its penetration is still relatively low. As the company picks up new customers and retains existing clients, it's not out of the question that we see sales triple over the next 4 years. Number 9. Olin Corp. OLN. Specialty chemical firm Olin may not be as big as other names in the sector, but with a focused operation on epoxies and vinyls, it's doing pretty well right now thanks to the stronger baseline sales to mature customers. A lot of investors like to make a fuss over OLN's Winchester ammunition arm, which is admittedly volatile with operations and could be under scrutiny if Democrats focus on gun control in the coming years. However, that segment accounted for less than 11% of fiscal 2019 sales, so even changes on this front are unlikely to upend the stock. Considering shares have surged about 40% in the last 3 months, investors should have confidence in the direction of OLN in November. Number 10. Sierra Bank Corp. BSRR. Another regional bank that has outperformed expectations lately is Sierra, a $300 million commercial bank headquartered in Porterville, California, with only about 40 full-service branches and roughly 500 employees. Regional banks are more exposed to local spending trends, which is a double-edged sword. Thankfully, BSRR is enjoying a stronger consumer and business environment than many of its peers in other harder-hit communities. Case in point, BSRR just topped earning estimates significantly in October, the 4th time in the last 4 quarters it has done so. This is clearly a stock that is on firm footing. And with banking regulators naturally watching its balance sheet, investors can have high confidence that its dividend is sustainable in 2021. As we barrel into November and yearn to close the curtain on 2020, these are companies that might begin delivering immediately, but are best served as long-term holdings to grow your wealth. Thanks for watching! While you're here, go ahead and click one of these 2 videos on your screen. See you there!